All right, welcome back, everyone. And today we have a truly exciting one because we're going to be diving into Michael Burry's 10,000 word short investment thesis on Palantir. Now, for those of you that have been around, you know that it's been quite a buzz, surrounding Michael Burry, and in particular his puts placed on Palantir and Nvidia stock. And he recently published a Substack article that was 10,000 word long. And I read through it, so you don't really have to. And I picked out all the major bear arguments and wrote a response to all of them. Because, the article itself, it is quite thorough. It is, well written. But it completely misses the whole point about Palantir. I mean, about 20 to 30% of the article is just, Palantir's founding, what they did, 20 years ago, not really relevant to the Palantir of 2026. So as we get into this, which by the way, you can find on my Substack, research.typefcapital.com, completely free. So if you go here, we're going to be going through it together. If you want to read it on your own, link in the description. But he brings up a lot of bear arguments which aren't really relevant to Palantir at all. And you'll shortly understand what I mean. So I want to preface by saying that I am a fan of Michael Burry in general. I think his past performance speaks for itself. Over the past 10 years or so, he has about doubled the S&P's returns. I mean, he's a good investor, no doubt about it. If you want to read his own, the piece that he published on Palantir, you can find it linked here. And before we get into it, my fair intrinsic value for Palantir is currently $206. Michael Burry's fair dollar per share is 46. So there's quite a discrepancy, about 4 times as big. However, using Michael's own forecast for revenue and such, just by simply adjusting, the dilution rate to reflect reality, the discount rate to reflect reality, his own model actually outputs about $200 per share as well. So is he bullish? Is he truly bearish? I mean, we'll get into that. So the first one, and you'll notice that many of these might not feel relevant. I mean, SPACs are certainly not relevant today. I don't really see how this is a bear argument, but we'll get into it. So SPACs lost money. This is false. And were an unforgivable mistake for Palantir, and they were done artificially to boost Palantir's revenue. So let's break this down. So what were the SPAC investments? So in short, Palantir invested in various SPACs during the SPAC bubble. In return, those companies would buy Palantir software, and those contracts were about 2 to 5 times more favorable than the typical contract that Palantir had at the time. So let's say that a Palantir contract was $2 million annually on average, and the SPAC would be something like 5 to 5.5. So they were very lucrative contracts for Palantir. And in return, of course, as I mentioned, Palantir bought equity in these SPACs. Now, many of those SPACs crashed post the SPAC bubble. Many of them even went bankrupt, but to this day, Palantir still recognizes revenue, and in total, they invested something, exactly 450 million in a bunch of companies. And to date, they have actually returned $454 as of Q4 of 2025. Now, how did I calculate this? Well, the thing with these strategic investments, as Palantir calls them, is that Palantir could sell off the equity immediately. They didn't have to hold it. Even if they sold the SPACs themselves, they still had to, honor those, contractual agreements that they had with Palantir of buying Palantir software. So at one point, as soon as Palantir started to receive equity in a business, they just sold it off. So by tracking the 13F filings, I estimated that they made something like 100 and I wrote it down here good so I don't have to remember, $132 in estimated proceeds, and the rest is just from revenue recognition from those SPACs. So if we look here, cumulatively, by 2025, now the quarter that was just reported on Q4 2025, they were actually net positive. Now, if you adjust it for inflation, whatever, they are still down. But I mean, it's not that big of a money loser as Burry makes it out to be. Now, more importantly, I don't believe that this was merely a way to boost revenues for Palantir, because it did do that. Like, they invested money, they had no debt on the balance sheet, invested money in SPACs, essentially got artificial revenue. That part, I mean, is not really arguable. That part is true, but I don't think that is why Palantir did this. I think the main reason Palantir did this is for R&D and domain expertise, because they got the opportunity, because these SPACs, they varied, they were across many different industries, everything from manufacturing to logistics to biotech. Like, it was a wide range of industries that Palantir invested into. Some emerging tech, UAV. So there's a lot of stuff there. And Palantir always says that they want that frontline experience, that frontline, learnings from these businesses. So by having all of these companies sign contracts with Palantir to use Palantir software, Palantir could actually deploy an FTE there, learn, okay, what this industry, what kind of problems are they facing? How do we resolve them? And the thing with Palantir is, once you solve the use cases within an industry for one customer, you can scale that to all other customers within the same industry. Let's take an oil and gas company, for example. Let's say BP. When you solve the issues that BP is facing is probably very similar to the issues that someone like Shell or ExxonMobil is facing as well, like Chevron. They're probably all experiencing similar issues. So once you solve it for one customer, you can scale that down. So I believe that the main purpose here was having very lucrative contracts, sure. But the main part was the actual R&D and domain expertise, that frontline, experience within a vast amount of industries. Now, Palantir has not invested in SPACs for several years. Like, this is not relevant anymore. So, okay, bear argument for Palantir, but I mean, this is not even a part of Palantir's business anymore. I mean, the amount of revenue that is still being recognized is just so tiny, like it doesn't really move the needle. So I don't get this one, but that's my answer for the SPACs. I think, one, they didn't really lose money. And sure, it was done to artificially boost revenues, but I think what is often overlooked is their R&D and domain expertise. Moving on. The margins that Palantir has do not reflect a SaaS company. Palantir is a consultancy. So throughout his report, Burry frequently references Palantir as a consultancy. And why does he do that? The reason he does that is that he sees FTEs as consultants, because they are sent out to a client to onboard them, set up the environments, make sure that the Palantir software is running. They set it up for the customer on site, similar to what a consultant would do. The problem he has here is that Palantir has over 80% gross margins. So it is seen as a SaaS, a software as a service company, because those FTE expenses are primarily placed in R&D, which is below the gross margin line. It is placed, among operating expenses and not in cost of goods sold. Now, what a consultancy like Deloitte or Accenture does is that they place consultant expenses in the cost of revenue. So if Palantir would do that, they would not have above 80% gross margins. And thus, it is not a SaaS company, and they would not get a SaaS multiple if they did not have this 80% gross margin line. Now, I don't know how the market would react to Palantir, not having 80% gross margins. But what I do know throughout many years of covering this company is that no one has ever discussed the gross margins for Palantir. It is not an intrinsic value driver. The intrinsic value driver is actually the operating margins, and the operating margins don't care where you place that FTE expense. If you place it in COGS, if you place it in R&D, doesn't matter. It will be captured by the operating margins, which is really what matters. This is actually about the profitability of the business, and what is actually an extension of the cash that is being generated at that company. It's a main input in free cash flow to the firm calculations. Gross margins don't really matter. So sure, let's say that maybe there is an argument for placing FTE expenses in COGS. For me, if that were to happen, I don't care. Maybe Burry is right. Maybe you guys know I never look at charts. I never look at how the stock is moving. I don't try to predict the market. I just look at fair value of a company. It could be true what Burry is saying, that it would not get a SaaS multiple if they were to account this way, like similarly to how Deloitte or Accenture does it. But in terms of what the business is actually valued at, what the value of the business is, it doesn't matter in the slightest. And he also points out that Palantir only has 27% operating margins as of Q3. He doesn't really touch on the dynamic where Palantir's operating expenses are largely static. Like Palantir has immense operating leverage, which means that as Palantir is growing, the margins are exploding upwards. So Q4 of 2025, they had 41% operating margins. Not mentioned in his report. He's not mentioning anything about the operating leverage. So what is that? Well, as you scale revenues and you don't really scale how much you're spending, in operating expenses, you get margin expansion. Very, simple concept. So here we have R&D expenses. They are pretty much static. It goes up slightly, goes down some periods, goes up some periods. So over time, it slowly ticks upwards here. But in relation to revenue, that is explosive and really what's the word? Not asymmetrical. It is growing fast. Is what I want to get to. And Palantir, as a result, is expanding their margin profile really, really quickly. Not mentioned by Burry at all. And sure, they are at 41% now. There's nothing indicating that 41% is the ceiling. I mean, I don't even know if 50, 55, 60% is the ceiling. Like, there's no ceiling in sight when you have this kind of operating leverage. Moving on. And this one is a main one that I think he got very, very wrong. And it ties into what Palantir actually does. So he mentions here that AIP, well, first of all, he says that the AIP is the result of a, panic-induced scramble at Palantir as OpenAI dropped ChatGPT. Now, that part might be true. I don't know how AIP came to be. He says that they built it in a few weeks by repurposing a previously defunct Palantir solution. I don't recall in my head what that solution was called, but basically Palantir had decommissioned a previous feature that they had for Foundry, to my understanding. And as ChatGPT dropped and an OpenAI employee came to the Palantir office, ex-Palantirian, he said, guys, this is the real deal. And then, Shyam, Karp, and everyone on the executive scrambled, and we got AIP. Now, it doesn't really matter how AIP came to be. It is an interesting tidbit. That story might be true. I don't know. But the problem I have with it is that he says that AIP is a mere wrapper of LLMs, and that it is a simply, a layer for other integrations to sit on top of. So he argues that AIP success relies on, LLMs getting better, and that, the integration layer keeps working for third-party solutions. If the third-party solutions, restrict access, or the third-party solutions start sucking or something like that, then it would affect AIP and make, Palantir worth less. Now, what's interesting here is that one of the core arguments that he has is that Palantir does not have any AI capabilities. They simply used machine learning prior to AIP, and since AIP, all they do is wrap existing LLMs. Now, we all know that LLMs are commodities, and particularly expensive commodities at that. Corp has been very vocal about it, and regardless of which LLM wins the race, they can all be integrated into AIP. Now we get into another risk that Burry states is that, LLMs are inaccurate. You can't really use them reliably at companies. That is completely true. You can't use them reliably at companies unless you have AIP. So he is indirectly describing here why AIP works so well, why so many customers say that you really need to use AIP to unlock value using AI, because you can't just take on a whole organization, a whole business, drop in, ChatGPT, be it Gemini, be it any LLM on its own, and expect it to actually produce value for you. You're going to have hallucinations. You're going to have mistakes. What makes AIP different is that you have the ontology, which basically maps up the context of your own business. Like every integration that exists has properties. You can see how every part of the business relates to one another. So you give the LLM model the context of your whole business, and that inherently provides guardrails, which is why so many customers say that the only way to use AI for mission critical stuff, as we can see in the military, or use it reliably for use cases across a business, is to use AIP because it has the ontology. You heard Jensen Huang say it, you heard Alex Karp say it. Chips and ontology are the core pillars of actually producing value from AI in the corporate, context. So Burry completely misses that, because what he believes is that AIP simply ties together an LLM with existing software solutions like Snowflake. That part is also wrong, because he explicitly says that AIP does not provide any actual functionality. And that is completely wrong. I mean, we've seen many use cases like AIP, Foundry, Palantir solutions. They act as an operating system. You build on top of the operating system, and you can integrate third-party solutions. And we've seen that at AIPCon, so many different customers, they each have solved various use cases for their own specific business using AIP, and they all look very different. They're all, custom solutions built for that customer. To my understanding now, I have not used AIP. It has not been available to me, but it's obvious by looking at the demos that these are, built solutions for that business specifically. It is not merely, Snowflake software running with an LLM attached, which is what Burry describes it to be. So he completely misunderstands what it is. Now, he says that if it's a mere LLM wrapper and an integration layer, it is very prone to competition, and it is not sticky. It is very easy to plug and play something completely different. That is true. But the problem is AIP is not a mere LLM wrapper, and it's not a mere integration layer. You actually build, it is an, operating system that is deeply integrated and, has built solutions specific to each company, and that actually makes it very sticky by nature, not non-sticky like an LLM wrapper would be. So this is one of the core points, and I think he gets it completely wrong. Moving on. Net dollar retention is fake and artificially boosted. This is one that I don't really get, and it's very obvious if you actually look at the number. So we're going to go through it. He says that by scaling small AIP customers, for example, from 500,000 to 2 million, Palantir gets a high retention on a low base. This inflates the blended net dollar retention figure. Now, that part is true. However, net dollar retention is 39% for the whole business. So, 139, sorry. I wrote it wrong here, I see. 139 is the net dollar retention rate. So it implies that customers that have been with Palantir for 12 months or longer, on average, grew 39%. Okay? Now, Palantir has 954 customers. 20 of those account for 42% of all revenue. So 20 out of 954 account for 42% of the business. And those top 20 customers, they're growing at 45.5% on a trailing 12-month basis. So it's not that small customers are inflating the number. Actually, the 20 largest, most deeply integrated customers, the ones that have been, the ones that are paying the most for Palantir and accounting for close to half the business, that cohort is the one that is generating so much value that they still keep growing at 45% despite being so massive already. So it is just plain and simply wrong that, this net dollar retention is fake and artificially boosted when you have your top 20 customers actually pulling that net dollar retention rate forward, because they are actually above the average by quite some margins. So I don't really get that. Another thing, he talks about how, Palantir did a DPO and described an acquire, expand, and scale strategy. So basically, get your foot through the door, often at a cost to Palantir, install the software, and then over time, that customer will scale up and start to sign larger and larger contracts with Palantir. Now, he mentions that it did not work because net dollar retention kept dropping off after they started reporting the net dollar retention number. Each passing quarter, it was dropping, down to a low of, I believe, 107, so 7% growth. That could be true. Until AIP was launched, that's when we saw an acceleration of the net dollar retention rate, which makes sense. I mean, Palantir had some issues in acquiring customers. I mean, they had no sales force. They tried one, didn't really work. They had to send FTEs out, to install the software. Maybe the companies were not cooperative. Like there could have been many reasons, but it was obvious that Palantir had a problem in actually getting out to customers, showing off their software because they had no sales force, and then efficiently installing the software and getting, those customers to actually scale, which is what we're seeing right now. AIP solved that. Boot camps solved that issue for Palantir. But historically, sending out an FTE is not cheap. Like, it cost Palantir a lot of money. And according to Burry, many dropped Palantir as a provider before or during the scale phase. So before Palantir could, reap the rewards of the field that they had sown, the clients would pull out. We're not really seeing that now because Palantir, they had to find an accelerator, and they did that. Boot camps really streamlined how Palantir onboards new customers. You don't really have to fight for that, get a foot through the door. Boot camps did that job for you. You could show off the software immediately to multiple potential customers at the same time. And AIP is really, a layer that is easier to integrate, to interact with for customers, easier to build on top of now that we're starting to see, a whole builders community surrounding Palantir. And to me, this is not a bare argument, talking about how it was in the past, 6 years ago. We're seeing that this is actually really working. People are really expanding the amount of use cases. They're expanding how much they're paying Palantir for AIP. We can see that, with the net dollar retention rate, for example, going up each passing quarter. Like, current customers are spending more and more. We know that AIP is probably usage-based, given a UBS report from 2 years ago. So I don't really see a problem here either. They identified a problem, they resolved it, and boy, did they resolve it efficiently. And we're not even talking about, when you start to deploy AI FTEs and you don't really have to send someone out physically to build out ontologies, at the customer locations and stuff like that. But we'll get into that in the next bear point here. The customer count is low. Competitors have more customers and are better positioned to leverage competitive alternatives because they have more customers. It is easier to leverage, their competitive threats, potential competitive threats to Palantir. Now, for those that have been tracking this company and the SaaS space as a whole knows that there's no real competitor to Palantir. Palantir integrates, all of these other, cited competitors like Snowflake, Databricks. You can use them as you build on top of AIP. Since, Palantir acts as the operating system of your business. These are, point solutions that is talking about. And I don't really get the argument here that, well, they have more customers, so they're better positioned to leverage those customers to launch a competitive alternative. Well, I would put it in a different framing here. Palantir has 954 customers as of Q4 2025. Snowflake and Databricks have between 12,000 and 17,000. Salesforce has about 200,000. Palantir has less than 1,000. And Palantir already has a larger revenue base than Snowflake. They're growing a lot faster than all software peers. And that is with just 954 customers. That just tells you how long of a run rate this growth has, because they're not even close to saturating. They're not even close. And we know from management commentary, I've also heard similar first-hand accounts of, customers trying to get Palantir software and being told that, no, we don't have the capacity to handle your inbound volume right now. And that's basically what the Palantir management said in the Q4 call. Like, no, we have to prioritize the largest customers right now because we're getting so many calls and we just don't have enough engineers to, deal with all the inbound volume. So there's a lot of volume. FTEs are the bottleneck right now, but as you start to scale out, AI FTEs doing most of the grunt work, not only perhaps quicker, more efficiently than an actual, FTE would do it, but also way, way, way cheaper. So imagine what Palantir's growth would look like as they start to approach these customer count numbers. So I don't see it at all as, they have a low customer count that is a red flag and the competitors are better positioned to leverage, alternatives, because Palantir does not have many customers, but everyone knows that if you want to extract value using AI, you have to go to Palantir. So I don't really see it as a risk yet. And also, speaking of how efficient they are becoming, the implied customer acquisition cost payback time is just 3 months as of Q4 2025. And this figure has been going down since the launch of AIP. That means that the cost to acquire a customer, that customer on average pays itself off within the same quarter that they are acquired. and that is trending downwards, like just getting more and more efficient. So I mean, I just see a healthy dynamic here. I'm excited that there are less than 1K customers. It just shows you how long of a growth run rate they do have once they start addressing, all of that inbound volume. So don't really get down to one as well. Here we have another main one. Stock-based compensation is rampant and founders are enriching themselves at shareholders' expense. Now, he mentioned something very interesting at the end of his article. I don't know if he made this metric up, but he mentioned that Palantir has a above 1 BS ratio. Now, BS stands for billionaires to sales. Palantir stock has created 5 billionaires. So Joe Lonsdale, Stephen Cohen, Alex Karp, Peter Thiel, Shyam Sankar. So 5 billionaires, and they only did 4.5 billion in sales in 2025. So the ratio is above 1, and that is the first time in global stock market history. So that is a funny tidbit. But the actual argument is that Palantir is overly compensating and that the dilution is excessive. Now, important here, Michael Burry, in his valuation model, he has a 4% dilution rate every year over the next 15 years. Actual share dilution is actually at 1.8% as of Q4 of 2025. So he sees that as doubling when the trend is clearly downwards. Like, I would agree that Palantir had a dilution problem a couple of years back, but I mean, it is clearly trending downwards. So Q4, 1.8% dilution rate. That is not excessive at all. And especially far from that 4%. Now, if we look at the option expense balance, it is going up. So this is since DPO. They had slowly started to recognize, expenses related to, issuing these options, RSUs and SARs. It is slowly going up, but nothing here tells me that, SPC is about to explode, Nothing with outstanding RSUs or options tells you that we're suddenly going to have 4% every single year over the next 15 years. There's nothing indicating that I can see. And as a percentage of revenue, SPC is at 14%. The average for the SaaS peer group is 23%. Palantir is almost at half of the average of the overall SaaS space in terms of SPC as a percentage of overall revenues. And that also, just like the dilution here, is trending downwards. So they're getting, it's becoming even less of an issue. So while it was an issue historically, it is not really an issue in 2026 and definitely not at a 4% dilution rate over the next 10 years. So with that said, let's get into how Burry arrives at 46 fair value per share for Palantir. So first of all, he has 50% growth for year 1 to 5, followed by 20% for year 6 to 15. So he has a 15-year model. The first one is really pessimistic considering that management is guiding for a 10x of US revenue over the next 5 years. A 10x, that alone implies that US-based revenues are going to compound at more than 60%, for through 2030. So already here you have some really pessimistic assumptions, but let's leave it at that for now. Let's just move on. 4% dilution rate, I just told you why that's not really realistic. Something like half makes more sense. If you want to keep it like in line with Q4, I think it's going to trend down even further, but let's keep it at 2%, just have a more realistic reference. And now we get into the discount rate, 16.6%. And he admits that that's what Bloomberg lists it at, due to the volatility of the stock. When you have a high beta stock, the WACC formula is built in a way where, it assumes that the business is inherently really risky. That's why the discount rate is so high. Now that discount rate, it reflects a business that is, in some deep issues. It reflects a business that is facing competitive threats, has structural problems, might be heavily in debt. It is just not realistic for Palantir at all to have a discount rate of 16.6%. But that's what uses 4% terminal growth rate, fine. That is about in line with the 10-year treasury yield. And then he doesn't mention the free cash flow to the firm margin if use that kind of model. But by calculating it, it's about 43% with these assumptions to arrive at $46. 43%, I believe, is what Palantir had for the whole year of 2025. So, okay, maybe just apply that, and then every single year is going to be 43% free cash flow to the firm margin. That one doesn't really make sense either, because why? Well, we looked at the operating leverage and the network effects that Palantir has. The margins are improving every passing quarter, and they're doing it, not in a slow and steady way. Like, it is exponential in nature. They are rapidly expanding margins, as they're also rapidly expanding growth. That's why the Rule of 40 score for Palantir is so impressive. When you combine growth and profitability, you get the Rule of 40 score, and they are at I don't even remember exactly, like 126, something like crazy high number. So it is a bit unfair to keep it static at 43%, because I believe that over time it would be a lot higher. So what I would do for Palantir to get a more realistic discount rate instead of 16, because that's really a distressed business, it's not really Palantir's reality. Palantir has no debt, no competitive threats, a deep moat, high barriers to entry. Like, Palantir has it all. They're executing. They have a long growth run rate. The contract balances, as RPO, remaining deal value, billings, everything, and even guidance from management. They are guiding to keep accelerating growth. It's not about to drop off. Like, it's about to keep accelerating. A more feasible discount rate is to use the implied equity risk premium for February, the current risk-free rate, and about a 2% business-specific risk, because there are some risks associated with Palantir. And if we do that, and then we use the Q4 2025 free cash flow to the firm margin, so we're not gonna increase it to some unimaginable high number, even though I believe that there's not really a ceiling. Like, it could be 60, it could be 65, some really absurdly high margin. But Q4 had a 55% free cash flow to the firm margin. If we use that for each period over this 15-year period, we use a 2% annual dilution instead of 4%, and then we have a more normal discount rate at 10.45. Burry's own forecast gives you $193 per share, about a 46% upside. So from $46, by just normalizing these assumptions to something more realistic, you get $193 per share. So is Burry bullish? Is he bearish? Who knows at this point? If you want to read my Q4 update on Palantir, it's really in-depth. I cover each part of the business. You can also find it on the Substack. And with that said, we are done. We covered the whole article. I'll link it into the description if you want to read it for yourself. If you want to read Burry's piece, you can do that. Let me know if I missed some major bear argument, but as we went through this, there's nothing really sustainable. Like, there's no real risk that he's raising that I see. Like, a lot of it is completely irrelevant to 2026 Palantir, or he has, completely misframed it to make it sound like something that it isn't. So I hope you learned something. If you have some feedback to me, let me know. Otherwise, please check out the Substack, research.typeofcapital.com, for my equity research, my own personal portfolio, all my valuations, all of that stuff. So thank you for watching, and I will see you guys next time. Bye bye.